Should you repay your mortgage? My friend thinks yes. The Economist magazine recently said yes, but also it depends. So my friend David recently texted me a triumphant email with the headline, "Sick brag." David included a screenshot from his mortgage servicer showing how by paying $25,000 early, he had saved $84,066 over the life of his mortgage. In response to my query, he filled in some details. His 30-year mortgage had a 7.38% rate, an original balance of $262,000. He was fired up about the seeming 336% return on money, which is the ratio of 84,000 to 25,000. And it's not that return, it's actually 7.38 is what he made. But after prepaying that lump sum, as well as previous and ongoing extra principal payments, he's down to $61,450.82 remaining balance as of today. My sense from our conversation is that his mortgage is not long for this world. This is good. Paying down big debts is both rare and commendable. I decided to mention David and contemplate his choice in part because the Economist magazine also recommended paying off your mortgage early. So, in an article from mid February, The Economist points out a few truths about mortgage rates and periods of time when early repayment would have made sense. In the 1980s, with interest rates in the low teens, paying off early was very compelling. In the ultra low rate environment between 2001, like after 9/11, and 2022, paying off early made less sense. Now, with 30-year mortgage rates significantly higher than 2022, but in the historically normal 6.5% to 7% range, what is the right thing to do? The economists explain their rationale based on two factors, and here I'm going to quote from them. They say, the opportunity cost of repaying a mortgage has outweighed the potential savings for years. This is especially obvious to those who fixed their mortgage near 1% before 2022, and that 1% is basically a reference to European and UK rates, because it's The Economist, but then watched as the rates on simple bank accounts rose to several multiples of that. Under such circumstances, overpaying a mortgage rather than depositing the cash and pocketing much more interest than repaying would have saved would have been nonsensical. For investors around the world, a hefty proportion of recent decades' high returns has come from ballooning stock valuations. 20 years ago, for example, the price of the MSCI World Index, that's Morgan Stanley's basic international stock fund, stock index, was 22 times as high as its company's long run average earnings. Now that multiple has risen to 30. Put another way, a big share of the gains came from sentiment rather than earnings. Unless investors continue to assign more and more value to each dollar of corporate profit, such a multiple limits the scope for future outsized returns. As a consequence, repaying your mortgage early looks more attractive now than it has in a very long time, even including those periods when interest rates were at today's levels or higher. So that's the Economist excerpt and their argument. The Economist logic begins with the heuristic of high interest rates, a signal to repay your mortgage, versus low interest rates, a signal to not repay. But it ends with a forward-looking view on international stock market valuation levels. Essentially, they are making the call on whether international stock prices are overvalued. I personally wouldn't follow that second view, stock market valuations, very far. I think it comes down to risk appetite, not market valuations. So, unlike The Economist, my second signal would rather be personal risk appetite rather than stock market valuation. How does it feel psychologically to be indebted? Let's ask my dog. How does it feel? Okay. Can you stomach the ups and downs of the prices of assets which you were able to purchase because you were levered? Or is it better in the end to just lock in the implied return on capital, which is the interest rate on your mortgage? By prepaying, you can avoid exposing yourself to ordinary market swings, which could be down 15% or up 15% in any given year, or even twice that percentage movement in extraordinary years. So from 2001 to 2022, 2 decades of extraordinarily low interest rates, the case for paying off your mortgage early was pretty weak. Having a mortgage comes with lots of advantages that can help diversify your nest egg and increase your net worth. Certainly, the advantage of paying off your mortgage early has shifted significantly over the past 3 years. My dog is now making a big noise. But before you dump all your extra funds into early prepayment, consider the advantages and your risk appetite. So the advantage of leverage, the advantage of having a mortgage beyond the obvious big idea that allows you to buy something important for which you don't literally have enough money, is that it is one of the few ways in which regular civilians can get sizable financial leverage for buying other assets. Financial regulation is designed to prevent the non-wealthy from using much, if any, leverage to buy financial assets. But mortgages are the exception. The leverage obtained through a mortgage is a big part of the reason why many people, many ordinary people, have had the happy experience of supercharging their net worth through homeownership. Few people, by contrast, have had the happy experience of supercharging their net worth through leverage on financial assets, even though that absolutely is also a thing. Financial leverage on financial assets via options, futures trading, repo transactions, and even 50% loan to value brokerage loans are the strong pharmaceuticals kept under lock and key behind the counter, only available with a prescription like a provable high net worth and signing paperwork that you agree to tons of fine print about the risks to your health and wealth. Looking at things objectively, leverage, rather than inherent real estate cleverness, is why lots of people have earned multiples of their original investments in their home, sometimes in a short period of time, like 5 or 10 years. A mortgage allows you to diversify your nest egg. To a larger extent than many of us realize, having a significant size mortgage, having leverage, is what allows us to accumulate other assets. In expensive real estate parts of the country, California, New York, Boston, the coasts, where a middle-class person could easily find themselves with $1 million mortgage, it is the fact that the middle-class person has a mortgage that allows them to actually contribute to long-term diversified tax-deferred accounts, like a 401k or a 403b. If they didn't have the big mortgage, but were forced to tie up every investable dollar in their $1 million+ home, then they'd have absolutely no money left over to buy mutual funds. Similarly, we can imagine drawing home equity from a HELOC or doing a cash-out mortgage refinancing as another or similar same way to turn home equity into diversified stocks in a retirement account. No mortgage means no diversification in expensive real estate areas. Do I think it is worth borrowing money with a mortgage at an 80% loan to value and therefore having enough money left over to contribute each month to a tax-advantaged retirement account full of somewhat less correlated, risk-correlated stock mutual funds such that you can grow your financial nest egg independently of your home? Yes. Yes, I do. Then there's the question of the advantage of the mortgage interest tax deduction. Unlike many, I'm not particularly in favor of this justification for keeping a mortgage or for not prepaying a mortgage. In my anecdotal experience, people overestimate the importance and advantage of the mortgage interest tax deduction. A numerical example of the advantage, but also limitation of the mortgage interest tax deduction might help explain my view. If you pay $10,000 in mortgage interest this year and are in the 25% marginal income tax bracket, you could expect to pay $2,500 less in federal taxes as a result of your $10,000 mortgage interest expenditure. But you still paid a net amount of $7,500 in interest. It's still a big expense. In no way was that $7,500 interest free, even though people act as if the mortgage interest tax deduction is some extraordinarily attractive free lunch that only the unsophisticated forego. The effect of the mortgage interest tax deduction is to reduce your effective interest rate from, for example, 4% to 3%, or from 8% to 6%. But you're still paying interest on your debt. I'm just pointing this out because it feels like people think they need to have a mortgage in order to be a tax-savvy person. You don't. You need a mortgage if, one, you don't have enough money, two, for a house, two, you appreciate the leverage, or three, you want to diversify your investments. You don't need a mortgage for the purposes of taking advantage of the mortgage interest tax deduction. It's just not that important. I started this post describing my friend's choice to drop $25,000 into his mortgage principal. Many do not have lump sums like this sitting around. We might only have hundreds of dollars per month extra. What about paying smaller amounts towards one's mortgage? How does that work mechanically? Interestingly, David's loan servicer is also set up to clarify for borrowers what happens with smaller early mortgage principal repayments. Since I've got a screenshot from the servicer's website and David's specific approach, I'll use that as an example. David currently pays $1,165.34 per month on his 30-year mortgage. His practice is to round up the monthly amount to $1,500, thereby adding an additional $334.66 in principal each month. Whenever you prepay principal on your mortgage, it's important to remember that this will not change the monthly payment due each month. That payment stays totally constant. What changes is that the servicer adjusts the entire remaining loan to the new smaller principal balance, which then incrementally adjusts a smaller interest due on all subsequent payments. Although the monthly payment due stays the same, the effect from the borrower's perspective is to shorten the life of the mortgage. What I like about David's servicer's website is that it makes explicit how much shorter the loan becomes, and therefore how much less interest he will pay over the long run. In sum, debt-free is always fine. That's the safest way. It's the least likely to leave you sleepless or regretful. It's clearly what David is on his way to doing. At 7 3/8 on his mortgage, that feels like the right move for him. At 2 3/4%, which is my old 15-year mortgage, or even 4%, however, I'd make a strong argument for keeping your mortgage to 1, enjoy the leverage, 2, diversify your holdings to other assets, 3, stay liquid on relatively cheap funding. In the end, the primary reason to prepay a mortgage comes down to whether you think you can beat the mortgage interest rate through owning other risky assets, and if you have the risk appetite for doing so. For me, this is the biggest reason to prepay or not prepay a mortgage. My reasoning starts and ends basically here. Question 1, what's your current interest rate? Question 2, what do you reasonably expect to earn with your money in the market? If answer 1 is greater than answer 2, then yes, pay down your mortgage early. But if answer 1 is less than answer 2, then don't pay it down early, unless you are very risk averse, which is also fine. Hopefully someday we'll get back to those low rates of 2001 to 2022 if you have a mortgage with those great low rates that were available in the 2022 or earlier era. I personally would not be in a rush to prepay any of it.